Hi, my name is Mike Gary, and my company is Yardley Wealth Management. We are a fee-only registered investment advisory firm in Newtown, Pennsylvania. That's in Bucks County. All right, so today I'm reading a couple of articles about the bond route, and what I want to do is put that in perspective for you. So sure, interest rates have moved up. The 10-year Treasury was yielding 2.38 at the close of business today, whereas July 5th of this year is 1.38. 1% change in interest rates when you go from 6 to 7 might not be a big deal, but from 1.38 to 2.38, that's a big move. And so interest rates and prices move at odds with each other. They're converse. So if interest rates go up, the value of existing bonds goes down. And so that's why they talk about rout. Now, let's put that into perspective. It's not nearly, bonds by themselves are rarely as risky as stocks are. And so if you have a bond that you have and you expect to get a coupon on it, it's not like having an individual stock for the most part. Sure, some bonds don't get paid, but the percentage of those is much lower than stocks that fail. And bonds typically recover quicker and don't stay suppressed as long. And bonds as a whole are nowhere near as risky as stocks as a whole. And we would never recommend you have an individual stock. I probably wouldn't recommend you own too many individual bonds either. But unless your bonds are junk bonds or long-term bonds, you don't have a lot to fear from bonds. We do recommend short and intermediate term investment grade bonds in U.S. and a lot of foreign countries, and funds, not individuals. But I don't really need to look or sound like Churchill to say that there's really nothing to fear from the bond route if you have high grade bonds and they're short and intermediate term. If they're longer term and kind of on the risky side, you might not want to have them in the first place, so you might want to reevaluate. Anyway, my name is Mike Gary, company's Yardley Wealth Management. Thanks for listening.